All right. Welcome, everybody. Thank you for joining our Common Audit Findings webinar. I'm Alex Sanchez, partner with the firm Pension Assurance. We're excited to have you. Thank you for carving out an hour of your day, of your Thursday, to join us and allowing us to nerd out on this information. And we appreciate you spending the time with us. We know it's not easy to carve out an hour in the middle of the day when you've got other things that you've got on your plate. So thank you for sitting here with us, whether you're a client or a service provider, just being able to sit in on this. And we hope that you'll have more than just a couple takeaways. If you're a client, thank you for just the years that you've been with us, whether it's been a year, whether it's several years. We really value the time that we have with you here today. And we just acknowledge you. Thank you for always entrusting us to handle your audits. Without you, we wouldn't be able to do what we do every day. So thank you for that. And so let's start diving in. We've got common audit findings today. That's what we're going to talk about. And a lot of this, we may have broached and talked about during our audits together over the years, but we're definitely going to dive into it a little deeper today and spend more time in them. So there might be things that we haven't talked about in this level of detail. So we hope that you'll be able to learn a thing or two. And if there's questions throughout the presentation, definitely feel free to toss them out through the chat, through the Q&A section of the webinar. And we'll definitely do our best to address them. If they're detailed to the point to where they're plan specific and we can't answer the question specifically to your liking, we can always set up a call afterwards to talk about it. No problems there. And then the other thing too is that this is a recorded webinar. So don't worry if you do have a call to take or an emergency comes up. If you registered for the webinar, then you will have access to the YouTube link afterwards along with the slide deck. So no worries if you miss a part of it or you want to go back. No need to take copious notes throughout because you will have this recording and presentation available to you afterwards as well. Again, my name is Alex Sanchez. I'm a partner with the firm, been in the industry for 20 years, 5 years with Pension Assurance. Absolutely love it. Just the opportunity to specialize in the retirement plan space is something that I really enjoy, and working with HR folks, CFOs, controllers in this space is something that I'm passionate about. And so, Jason, you want to say a couple words?
Yeah, sure. So Jason Figgett, again, super happy to be here. I'm happy to share some experience and war stories with y'all during the webinar today. I've been here with Pension Assurance since January of 2021. I've been doing benefit plan audits for over 15 years now. And I, like many of us here, including Alex, are what I like to call recovering corporate auditors. Many of us, especially who worked at other firms, came here specifically because it allowed us the opportunity to focus solely on doing benefit plan work. And just being able to have that sole focus without distraction, I think really does kind of, it bleeds through in not only the work that we do, but the interactions we have with our clients. And I just really appreciate that.
Absolutely. And then I'm in South Florida and Jason's out in Northern California. So we've got both sides of the map covered here today.
That's why Alex is biased about having this be in the middle of his day. He's already interrupted my coffee this morning for this.
So good. Yeah, it's 78 degrees and nice out here. So I hope that it's just as nice, if not better, in your part or your neck of the woods. But
always.
Yes. So let's dive into just a quick fact sheet on us. We are 100% specialized as far as just the revenue source. 100% of our revenue source comes from the EBP space. So we don't do anything else. We don't do corporate audits, corporate tax work, consulting. This is our baby. This is what we focus on. All our resources, energy, training, education towards. And so what does that mean for you all? It's, efficiency, just that we try and strive for the clean, pain-free audit. That's what we strive to do and achieve, and we'll go through our mission and objectives and everything. But that's really it. When I hear at the end of the audit from a newbie who's going through the process for the first time, and they say, "Oh man, I was so stressed out going in, but you made it so simple." Those are the types of things we love to hear. And so we try and leverage the service providers and the connections that we have to make the process seamless for you. And we hope that's been the case with the experiences that you've had with us thus far. Deep experience and expertise. So last year we audited 900 plans, $19 billion in plan assets, and 510,000 participant accounts is what was made up in those 900 plans that we audited, right? So experience, we've got 60 plus professionals scattered throughout the country. We have a brick and mortar office in Agora Hills, California, but these audits are pretty much done remote because who wants an auditor in their office, right? So we've got the experience and everybody's dedicated to this space, just like we are. Our vision, to become a national leader in the area of retirement plan audits in quantity, quality, and subject matter expertise. That's it, simple and straightforward. And then our mission is to deliver value and education to our clients through our retirement plan audit process by cultivating a team of experts that provides the highest level of service and efficiency. And that's part of why we're here today. We're not just here to check a box and get through your audit, but more so to teach, train, develop, make your plans run better for you, and make the experience the best it can be. Here's our objectives and what we'll go over today. Jason and I will toggle back and forth to try and keep you on your toes and awake. I know it's a lot of information, and you know, who wants to hear about the IRS and DOL and audits, right? So we try and just do it in a way where it'll be informative and fresh, and try and bring a perspective that's just more easy to go through and hopefully, you know, comprehend, understand, and we'll try and make it run smoothly here, and hope that you'll be able to have more, like I said, more than a few takeaways on this. But we'll go through timeliness of contributions. Jason will go through definition of comp errors, then miscalculation employee-employer contributions, excluded participants and enrollment issues, NDT testing and what can go wrong there, misapplication of forfeitures, incorrect vesting calculations, and delinquent filings, right? So what does the DOL ask for us, and what can you potentially see if there is a situation where you get caught in a delinquent filing situation, right? So we'll go through all that. And again, feel free to ask questions. We'll try and address those as we go. So timeliness of employee contributions to the plan. This is probably something you have seen on every audit that you've been involved with, right? Because this has been around forever. It's something that the DOL harps on every year. They see it as if you hold back the funds, if you hold back the money that's employee deferrals, that it's really borrowing money from the employee, right? So it's a big no-no. The corrections for this, if there is an error, it's not a huge amount of money. It's not a huge fix, a monetary burden, if you will, but it's a big deal in the eyes of the DOL because it's a benefit that's lost on the employee side if you hold back that money and they're not able to invest it when it should be, right, invested. So timeliness pertains to all employee contributions. That's important to note, not just employee participant deferrals, but loan repayments as well. So you want to make sure that loan repayments are set up, you know, timely as soon as they're requested, and that those loan repayments are going through as soon as they're supposed to be, along with those participant deferrals, and that there's no lapse. You know, sometimes I've seen months, 2 months, 3 months where the loan doesn't get set up and it goes into default right away, right? And so you want to avoid that by putting the right controls in place there. Timeliness rules, if you were a small plan filer in the past, you probably know the safe harbor rule that is set up for small plan filers, which is a 7-day safe harbor rule. So, you know, as long as you remit within 7 business days, you're totally fine. Under a large plan, it's completely different. They look at reasonably possible as it's a terminology that they use, and it's very subjective, right? But there is a line in the sand as far as that rule is concerned. The DOL states that they want you to segregate the funds from the plan sponsor's general assets, but in no case later than the 15th business day of the month following when those monies were withheld from participants. So you want to make sure it's as soon as reasonably possible, but there is that final line in the sand of the 15-day rule past the pay date that you're supposed to be making that remittance, right? So if, let's say your pay date is July 1st, no later than that 15th business day in August is when you have to remit those funds by. But, you know, from what we've seen in investigations and just talking to the Department of Labor, different parties within the Department of Labor, they are looking for reasonableness, right? So if you have a precedent and you have a standard of 3 to 5 business days that you've already set, then you want to make sure it's as soon as reasonably possible. But there is that final line in the sand as far as that rule is concerned. The DOL states that they want you to segregate the funds from the plan sponsor's general assets, but in no case later than the 15th business day of the month following when those monies were withheld from participants. So you want to make sure it's as soon as reasonably possible. But there is that final line in the sand of the 15-day rule past the pay date that you're supposed to be making that remittance, right? So then they're going to look at that, and they're going to look at that as your standard, right? So they could come in, depending on what side of the bed they wake on that morning, look at your deposit schedule, look at when you've been doing it. And if you've been practicing 3 to 5 business days consistently, but then they see a couple outliers of 7 or 9 business days, even though it doesn't pass the 15-day rule, they can call those out as late. And then, you're going to have to call those out as a prohibited transaction. Sometimes maybe no, maybe there's a valid reason for it. Maybe you had a switch in payroll systems and that's why you were a little late that pay period. But I would make sure that you document that if that is the case. How do we know? How do I know if, for instance, you have reported late remittances? It has to be reported on your 5500 within the Schedule H. So this is what that looks like. There's a compliance section, Part 4, within the 5500, where it doesn't matter if it's just one late remittance and it's small dollars. You have to check that box, that yes box, and put the gross wages associated to that payroll. That $1.6 million that you see on the screen there is not the penalties that were assessed. It's the actual gross wages associated to those late contributions. So don't be alarmed by that number. We haven't seen it go that big. So, and we'll talk about corrections and how that works. But that's how we know. That's how the general public knows, because these are public filings, so everybody has access to it. And so it becomes a red flag, especially if it's not fixed. This does stay on your 5500, something to note, until the year it gets fixed as well. So it's not just the year of the error of the late contribution, but it stays on and rolls forward into subsequent 5500 filings up until the year that it's corrected. And so we'll talk about the correction. How do we find this mistake? So if let's say you're new, you come into the company and you want to know how the company did over the last year, you can perform a reconciliation of contributions into the plan each pay period to help ensure all contributions during the year were remitted timely. So, it's something that the auditors do as part of the audit, but it doesn't hurt to do that internally. Do a mini audit yourself. Look at all the pay dates for the year, log in all the deferrals, the contributions that were made, compare those to the record keeper information, see when they hit the record keeper, and then, do the delta on the number of days that it took to get the money into the plan. And that's how you can figure out whether you were consistent, which were the outliers, why were there outliers, how do we avoid the mistake. You can implement a process to upload participant deposit funds within a business day after the paycheck date. Sometimes, the thought process is if you can remit, payroll taxes within 3 business days, then you should be able to remit 401k deferrals around the same time frame, right? So, but make sure that your whatever process and policy you're put in, that it is realistic and that you can actually do it consistently throughout the year. If you're still remitting by check, consider electronic transfer. Consider also reaching out to your payroll provider to determine if contributions can be remitted through an automated process. The more you can automate, the better, right? The less manual errors you can have and take out of the equation, the better your process will be. And, it depends. As far as the policy, people ask, what should the policy be? Should it be 3 days, 5 days? It really depends on the plan's makeup, your service providers. Who do you have for payroll? Do you have 360 or 180 integration? What does that look like? Because for someone who has 360, where they don't have to do a lot of manual labor, 3 days could be just right? But maybe not the case for somebody who has a manual process and maybe not an off-the-shelf payroll provider, but more of an in-house payroll situation where there's a lot of manual buttons you have to click through. So fixing the mistake, there's a couple ways. Typically, the IRS self-correction process is what is done for these. So you have to calculate lost earnings for that time that the money should have been in the plan to make those participants whole. Note that self-correction is not technically complete until both lost earnings have been funded to the plan and a Form 5330 has been completed as well. So excise taxes on lost earnings contributed, that's what the Form 5330 will report to the IRS, and that has to be filed technically for it to be completely fixed. And you can really rely on your service providers. They should be able to help you, walk you through how to make that happen. They'll need the information, of course, to be able to do the calculation for you, but they should be able to help you out, whether it's a TPA or a bundled service provider up on the record keeper side. DFCP program typically requires the involvement of a ERISA counsel. So, because it's a little more expensive to go that route, it's for this time of contributions, it's typically not the route that most clients will go through. Now, if you have a drastic situation where it's very severe and it goes back years, and maybe it's something that you want to entertain, but typically not the case.
Thanks, Alex. So, definition of compensation errors. Aside from delinquent contributions, definition of compensation errors are probably also the most common, or just a very close second in terms of how often we encounter them as errors or as issues on the audits that we work on or have worked on historically. It's not like this is something that is new. This feels like this has been a perennial problem, at least it has for me, since I started my career. So some things to be aware of when we're talking about definition of compensation. The first thing to be aware of is that every plan's, or I would say most every plan's definition of compensation is going to be foundationally based upon one of three basic compensation types: W-2, 3401A, which is technically a subset of W-2, or 415 compensation. Now, each of those baseline definitions, typically for most plans, will have a series of modifications or alterations to those baseline definitions that are then deployed for the plan. So you may have W-2 compensation, but it excludes anything that's fringe related, maybe bonus compensations excluded, or commissions or something else along those lines. And if you're thinking, well, if people are allowed to do these additional alterations to the foundational compensation type, doesn't that mean that if I'm messing with it, I'm just more likely to get in trouble? And the answer is no. In fact, I almost feel like it's the opposite, that when you run with just a W-2, no exceptions, you might think that's the easiest sort of compensation type. But personally, in my experience, I feel like a lot of things start to fall through the cracks that you technically should be including, or you should be including that you are not. So don't be scared if you realize, oh shoot, my plan has a lot of caveats and exceptions and alterations to these baseline definitions. The baseline definition, that's not a problem. In fact, it may be a feature. But just be aware that it's a complex moving target. Might be the primary takeaway that I would want, if nothing else, to stick with in your mind when it comes to definition of compensation. The definition of compensation really impacts everything. It's the primary factor in what is used to compute both the participant contributions to the plan as well as any company contributions that are coming into the plan. And be aware that plans can have different definitions of compensation for company contributions versus participant contributions. It doesn't always happen, but it's absolutely possible. It's infrequent, I would say, at least in my experience where I've encountered it. But it's definitely there, and it's a possibility that you need to be aware of, whether you're a sponsor yourself or an advisor. Typically, the most significant error, most significant in terms of dollar impact that you may have to deal with when it comes to definition of compensation, are going to be to those, for lack of a better term, flagship compensation types. People rarely get regular compensation wrong, but as soon as you move off of that to bonuses, commissions, overtime, holidays, what do you do with the payout of PTO and things of that nature? That's really where the errors can begin to compound and ultimately result in what may very likely be a significant dollar correction being required for the plan. And it's also not uncommon that as soon as you start adding pay codes for new activities, that those are missed when you're considering whether or not they should be included in your calculation of deferrals. But as an example, when we were all collectively in the thick of COVID, I have a couple clients actually who, very well-meaning, set up a couple of compensation codes that were specifically tailored to address certain needs of their employees, for COVID related activities, working from home, office stipends, things of that nature. And it was only when we came along and did the audit that we realized, hey, based upon your definition of compensation, for some clients, some of these should be included, some of these should be excluded. Honestly, for most of them, they were just completely out of sight, out of mind, because one aspect of the business had thought, hey, this is a good idea, and this is something we want to do, again, with the intention of supporting our employees, without failing to understand or possibly even consider the fact that this is going to impact the benefit plan, and this is going to have knock-on effects that no one was considering when they were first trying to deploy these changes. So if you've had, and we'll talk about this here in a minute, but if you've had any new compensation codes added to your payroll recently, you really should take a look at them, because you want to make sure those are being treated correctly one way or the other based upon your plan's respective definition of compensation. So when it comes to finding, avoiding, and fixing the mistake, for finding the mistake, as I had kind of already mentioned, it's really important that you want to review your plan documents and really make sure you very specifically understand how your payroll is configured relative to what the provisions are for relative to your definition of compensation being deployed for your plan. If you're unsure exactly what that looks like, or even just how to interpret all those various boxes, if we're your auditor, you can ask us. If you have another auditor that you're working with, you can ask them. If you have advisors, if you're you have clients who either have these questions, or clients who have been changing their payroll codes frequently, you should really reach out to them and do them a solid and try and help make sure that they understand really that they're fully aligned the way that they should be. And I cannot emphasize this enough. It also is probably worth your time to also take a peek at your underlying plan document. Most of the time, plans are built with an adoption agreement and then a plan document that's kind of underneath it. Don't neglect that plan document. See if it has any additional caveats or carve-outs that you might be able to find are applicable to your particular plan, and may be able to help you justify what you're doing. I've many times had clients that have succeeded despite ignorance. They pulled a homer, where they were absolutely not knowing that they were doing it correctly, and it's really just kind of by the good fortune of how the plan was designed in the first place, where there were a couple safety nets that kept them from completely falling off. But really, your best defense against this, or the best way to find whether or not there's any problems here, is to just kind of do a thorough vetting yourself to make sure that you're fully aware of what's being done and how, and really how your payroll is being deployed relative to the definition of compensation that's in play. We would also suggest that for any, if you're curious of like, well, shoot, I think we're okay, but how can I kind of put some dollars to that surety? We would suggest looking at your 5 largest compensation types that you have at your company and or organization, and make sure that they are being properly treated when it comes to participant contributions. That's a fantastic, I think, relatively low-hanging fruit that you can take advantage of when it comes to ensuring that you're on the right side of the line when it comes to definition of compensation. Periodic self-reviews over how things are being calculated is always advisable, in addition to looking at these 5 most significant compensation types. Also, as I kind of alluded to previously, if you know that you've either added some compensation codes, or if you're not sure, ask. Or if you know that you've changed payroll providers recently, cannot emphasize enough just how often we run into errors when one moves from just one payroll to another. Everyone assumes it was all set up correctly, but that is by no means where you want to be operating from. You very much want to make sure you fully understand how your new payroll is being deployed, or new pay codes are being deployed, again, relative to your plan's specific definition of compensation. Corrective contributions can be required from the plan sponsor to the plan if there are ultimately missed deferrals as a result of compensation errors. It also goes the other way, where if you have ineligible compensation being contributed on, it may ultimately result in corrective distributions needing to happen from the plan, and those would typically be taxable events for whoever was impacted. So again, it's really, you want to try and treat this with as much care and attention as possible, because when we do have errors here, they can be significant. And ultimately, at the end of the day, if you have errors that are of significant enough nature, both either in quantity, quality, or both, it may be advisable to bring in an ERISA specialist to help make sure that you can navigate that, successfully.
Good stuff, Jason. I think the big thing there too is that there is no statute of limitations when it comes to definition of comp issues. So if you find an issue, first time audit, or just something that that goes under the radar and it goes back years, it may be a costly one where it might make sense to bring in an ERISA attorney.
Yeah.
So miscalculation of employee and employee contributions. This is something that can come about in many different ways, right? So, you see the table here. These change, the deferral limits change every year. These compensation limits, they change for purposes of inflation. So, making sure that payroll is lined up in it and is updated for these changes year to year is so important, right? So, you don't want to just rely on your payroll service provider to make sure that those are updated. You want to check in and rest assured that they are. Especially if you're on an older platform, maybe you haven't been updated, maybe there's a glitch that happens. So, maybe mark your calendar for every January, right, to check that those did go through accurately. So the use of incorrect definition of compensation as discussed is one reason why this can get, you can find an error in this area. Limits not properly set within payroll, as I mentioned, for both eligible compensation, annual deferral limits. Remember, there are multiple limits. So, and depending on the plan provisions, you may need to keep a close eye on more than just one. Failing to update deferral election changes within payroll, annual auto enrollment, auto escalation errors. So, now with Secure 2.0, this is prevalent in a lot of plans. Now, every new plan that gets set up needs to have auto enrollment, and that's the way the future of this space is headed, right? Because the government wants more people to save and use the 401k as a vehicle to be able to save for retirement. Auto enrollment's big, right? So, and it sounds great, more people can get in, more people can save, which is a phenomenal thing, right? But if you don't have the systems in place for it, it can get out of control and it could become a major issue. So auto enrollment, making sure that you are allowing people to participate when they're supposed to based on the eligibility rules, very, very important. For new employees, failing to account for contributions to a previous employer's plan within the same tax year. So, if, let's say they work for 2-3 other companies during the same year, are they keeping track of their own deferrals? They could very easily contribute more than they're supposed to, which would require a refund back to them, which would create a taxable event for them. So are there parameters in place to account for that? And are there controls set up and what are they? Just knowing what those are and where the landmines could be would be important to know, right? Failing to capture contributions under your prior payroll system after changing to a new payroll system. I think Jason talked about it with the definition of comp, right? Anytime there's a change in payroll system, you have to be hyper aware of what can go wrong. And this is one area that can definitely go wrong there. How do we find, avoid, and fix? Understand the various applicable IRS limits, right? So know what those are. Understand the matching formula as defined in your plan documents. Is it a safe harbor? Is it 100% of the first 3 and then 50% of the following 3? Is it straightforward? What is that calculation, and is that what's set up in payroll? Is it a fixed percentage that's specifically written in your plan document? And if that's the case, then there's no wiggle room unless you amend the plan, right? So sometimes there's the disconnect between management, ownership, and the HR team. And so, they might think that it's discretionary and you can change it every year, but the plan doc might have a fixed match percentage calculation there. So, making sure that you're making sure you're connecting the dots on those things is important. How do we avoid the mistake? Review plan docs and payroll to help ensure all aspects of the plan and payroll are properly aligned. Examine your internal controls to help ensure there is at least a periodic check to verify participant deferral rates are properly recorded in payroll. Even an automated system can have holes in it, right? So you want to make sure that you're looking at the controls that are in place. And if you spot check those controls, you'll be better off, right? So doing a mini audit, if you will, looking at a sample of employees that maybe have been around for a while, employees that haven't, that are new hires, employees that termed out, maybe checking the final payroll to make sure 401k was deducted from that final paycheck. Those are all key things to look at. And if you feel comfortable that those things are happening, then the audit should be a breeze for you, right? Confirm contribution and compensation limits for the year that are properly set up, that they're properly set up in payroll. There's an increased risk if your employer contribution eligibility and your match eligibility differ, right? So your employer and employee deferrals and the eligibility for both on both the employer and employee side, if they differ, there's an increased risk of miscalculation, right? Because if, let's say, your employee deferral limit is your eligibility is 3 months, but then you're not eligible for a match until after a year, can your payroll be set up in that way to allow for that difference in eligibility? And are the proper controls and parameters set in place to be able to do that? If not, if it's, let's say, the match gets automatically calculated based on the deferrals, then you're going to have an overmatch where you have matching dollars after 3 months based on the employee deferral eligibility rule instead of your 1 year parameters that are set in the plan document, right? So again, you want to make sure the plan document and the provisions in the plan make sense for you and your operations. So sometimes those decisions are made at a high level, but it's good to have everybody in the room making those choices so that it makes sense for all. Corrected contributions or distributions is the way you can fix it, right? Depending on the direction of the error, if it's an over contribution or under. And then this also can be expensive because it can date back years if it goes unfixed, right? So again, no statute of limitations here.
So before we get on to this next section, there are 2 questions here that I want to make sure that we address before we go any further. I'm going to work through them backwards as the order they were received. The first question relates to actually what you were just discussing, Alex, which was, does your platform update, like UKG, for example, UltiPro, for those of us who remember, update the annual contribution amounts, or does your 401k provider, for example, ADP, 401k, update the annual contribution amounts? Honestly, in my opinion, this is where I'd love to hear your thoughts as well, Alex. I think it depends. It's one of those situations where I look at it and say, you want to first understand what's supposed to be happening, but to kind of share with y'all some, auditing wisdom that I learned very early in my career, it's trust but verify. And so even if you have robots that are supposed to be helping you out and making sure that your deferral rates are being properly set in your system, ultimately, at the end of the day, fiduciary responsibility for these plans still resides with you, plan sponsors, or maybe with you, fiduciaries who are also third-party fiduciaries who are on this call. And so you want to make sure that the robots are doing what they're supposed to be doing. So that would be kind of my 2 cents there. Does that sound reasonable to you, Alex?
Completely agree. Really, I mean, the payroll provider, they're not all one and the same. So you want to make sure you ask those questions because they run on different systems. So and make sure that what the record keeper versus the payroll provider is supposed to be doing, that they are doing it based on your service agreements.
And if you ultimately find that you're like, well, I'm checking that it's wrong every year, or I have to do it, maybe the question you should be asking yourself is, why am I paying for this service? And maybe you need to look for a new service provider. So, take that as you will, but I think that it sufficiently answers that question. If it doesn't, whoever asked it, you can ask us to elaborate further. And then the other question that was asked was, what are the common modifications to the definition of compensation besides excluding bonuses, commissions? And then the second part is, why would simple W-2 definition of comp be more complex than we think? This is where I wish we were either live or I had a whiteboard. But if you, for example, go to the IRS's website and you look at the 3 basic definitions of compensation, so W-2, 3401A, and 415, you'll see that there's actually a whole listing of items below that, of like a whole litany of items. For example, fringe items, group term life, expense reimbursements paid out under a non-accountable plan versus an accountable plan. Those are all kind of the nooks and crannies where plans get into trouble. Now, it's very possible if you run into troubles there, they are unlikely to be quantitatively material, so they wouldn't necessarily hold up the audit, but they are going to mire you, frankly, in correction hell, trying to get those things fixed. And so really where I typically see problems with plans is you do occasionally see the more big ticket errors. For example, I'm working with a client right now that currently has a filing. I can never remember the acronym, so I apologize. They have a filing currently with the IRS to basically say, hey, we are excluding our non, how do they phrase it? Our non performance-based bonus compensation from the plan, but we are including our performance-based bonus compensation in the plan. And the ERISA attorney that I work with there is very knowledgeable, and they actually shared with me they said, actually, there's an IRS circular that says the non-performance-based bonuses can actually be categorized as fringe compensation. And because the plan excludes fringe, we can exclude it under that flag. But this other bonus stuff we should continue to include. And so again, that's like, we're starting to talk about figuratively kicking over rocks and finding all sorts of bugs and other things underneath it. And so when it comes to definition of compensation, I cannot emphasize this enough. Do not ever assume it's simple and straightforward, because honestly, it rarely is. Unless you're truly one of those unique unicorn clients that is like, everyone here gets regular comp and they get a bonus at the end of the year and that's it, then awesome. Then you probably are right. It's probably not that complex and you probably get an easy handle on it. For most other companies as they operate, there's just such a variety of compensation types that are going on that it's not uncommon through the fault of no one individual to have things slip under the radar that honestly just no one even knew to look in the first place to say, do these need to be properly included or excluded? So I hope that's answered both of those questions sufficiently. It's again, it's just one of those things that I've just found over the years that I wish it was simple, but it's almost it's never anything but, generally in my experience. So moving on with the rest of these slides here. When it comes to excluded participants and just other general enrollment issues, Alex already touched on this. So he stole a little bit of my thunder, but that's okay because we just spent some time going through these good questions. The Secure 2.0 is kind of really kicked in the door when it comes to auto enrollment. And while it's not, well, it certainly has problems now, those problems are only going to be expanded exponentially in the coming years, especially once the mandatory auto enrollment feature is live in the law, which I think is in 2025, if I remember correctly. And in those situations, really, like I said before, you need to make sure you're paying attention to the robots. Auto enrollment is one of those things where if you are not paying attention, it will just continue to make errors and mistakes until somebody stops it. It's not going to fix itself. And if you say, well, somebody should be fixing it, I agree with you, but I don't know what to tell you. Unless somebody's like actively monitoring or checking in on it, it can very quickly, very easily get out of hand. So I would definitely say to anyone who has auto enrollment features with their plan, and you might be thinking, well, we've outsourced it to a third party of some sort. I would still say again, you are behooved as a fiduciary to really just at least periodically check new people that you would have expected to be auto enrolled in the plan to make sure all the boxes are checked. If there are no deferrals, make sure you have evidence that they opted out. If there are deferrals, did they happen when they were supposed to? Did they happen at the rate they were supposed to? If you have an automatic increase, is that increase happening at the appropriate increment and in the appropriate amount? Again, it's just one of those things where so much of it becomes automated, it becomes out of sight, out of mind. And so really you're only benefited by just creating these manual, mandatory, just periodic spot checks along the way are really the most bang for your buck way to be able to protect yourself. Kind of parallel to the auto enrollment issue, but this one's a little bit more broad-based. Participants just generally being enrolled too early or too late. Too early is, I don't think, generally too much of a problem in terms of especially how you would fix it. Too late is really where the problems more come to bear. If you have a 403B plan, and you have people who are not being included, who should be included under or not participating under universal availability. That I have found that to be generally less of a problem because who's eligible? We're all eligible. And so it's not something that I typically find as being a problem, but it's certainly still in that realm of possibility. And so we want to make sure we address it here. Missed participant enrollment and deferral change requests. This one is something that I think you see as an error, even in systems that are supposed to be fully integrated. Why do they happen? I don't know. Mysteries of the universe, I suppose. But again, just because you have this feature in place and where generally it likely is not going to result in there being any problems, it is still a real possibility of something that could be present there. And so again, you just want to be aware, and this is a problem that we see to where those two systems are just not speaking to each other as timely as they should, or there are disconnects, and sometimes no one's really sure why, to be completely honest. And then again, potential corrections here could be rather extensive depending on the time that we're speaking about here. All right. So in terms of find, avoid, and fixing the mistake. So as I was mentioning previously, really performing self-reviews over the activity that's happening here is really your best protection when it comes to enrollment issues. Make sure you have a thorough understanding of your plan's eligibility requirements. Again, it's not uncommon to see plans where the requirements to contribute to the plan versus the requirements to receive company contributions are two different things. And so if you're not sure about how that's being tracked, who's responsible for that, where's the information coming from? Those are all really good questions, and you should make sure you have an answer to those. I will say that in terms of avoiding the mistake, one of the most critical things that I can suggest personally is that you want to put some just baseline fundamental controls on ensuring that participant data that you're communicating to your record keeper is being sent completely and accurately. How do you do that? Spot check a couple people. Make sure the person who's entering the data physically into the system is different from the person who checks, if possible. If that's not possible, because you have a very small department, then I would say you make it a control to say, I enter the participant data here, and then in a day or two, I'm going to go to the website. I'm going to look up 2 or 3 of these people that I just entered and make sure that their data over here agrees with the data that I entered here on my end. Either one, any of those things are things that you could easily do to help counter to help reduce the possibility that the information is being sent incorrectly. Because again, so much of this is automated. You really want to try and nip it in the bud, and you want to be able to try to hedge off any potential systemic issues that might be happening because data has been entered incorrectly. Again, if you do end up finding mistakes, there's always a way to fix it. Qualified non-elective contributions may be necessary in terms of how you calculate those. If you're an advisor, you should know. If you're a plan sponsor, look to your advisors or talk to your auditor, whoever that may be, whether it's us or somebody else. And they'll be able to point you to somebody who can help you make those calculations. Notify participants. And really at the end of the day, and we'll talk about this a little bit later, something else that we'll be discussing as a separate topic. But remember, at the end of the day, like ultimately the DOL is not in the business of shoving plans down. Really, as long as you are looking out for participant best interests, whether it's any of these previous exceptions we've talked about or any of the future ones we're going to be talking about here shortly, as long as you're doing all you can to do right by them, you're going to be okay. And so that's really kind of the mentality that we really embrace and try to foster amongst our clients when they're asking, what do we do about these problems that we've encountered?
Great point, Jason. NDT, so non-discrimination testing. I think the big thing here is really failing to put or provide the right information as far as census data to your TPA. So garbage in, garbage out, like the first point says, if you're not reconciling your census data and making sure that it does, tie into your payroll information, then there's going to be issues right? And when if let's say you failed non-discrim testing and it's based off wrong information, that's even worse, because now the correction methods used to fix the errors or excess contributions, if you will, related to the testing might be based off incorrect data that needs to be fixed again, right? So, and anytime a TPA needs to rerun non-discrim testing, it's additional cost, time, and energy to get that done. And if you wait until the audit rolls around 6-7 months later, then by that point in time, the ways to correct are limited as well, because there's a timeliness of this information that needs to go through process and testing to be completed, so that you can make those corrections easily without having to pay additional penalties. So typically it's really the plan sponsor's responsibility to identify key employees and highly compensated employees. So knowing who makes up the highly compensated employees for purposes of testing is important. And then typically failed non-discrim testing either requires refunds to HCEs or a qualified non-elective contribution, additional contribution to the plan. So there's different things as far as ways of fixing it. Finding the mistake, really, you can spot check the census data. As Jason had talked about, having two sets of eyes on something is always a good way to go. So if, let's say, you have a payroll person that's populating the census information and they're in the weeds, really looking at every line by line, looking at making sure that all the gross wages are in there, it's very easy for a payroll person to miss, something, right? So it's for anybody to miss populating a census, right? Especially when you've got maybe several entities involved. So having somebody above that person, maybe in finance, spot check to make sure they're doing a reconciliation, comparing it to payroll before you hit that submit button, I think would be a very, very good control to have. And if you don't have that ability, because the departments are limited, having somebody outside in a different department that has some sort of finance background and say, hey, can you please spot check this with me, have a second set of eyes on this before I send it off to our TPA. I just want to make sure it's good before we send it. Doing that and doing it timely just after the end of the year, and really knowing what you're submitting when it comes to your year-end questionnaire from your TPA. Filling out that questionnaire is important, making sure that you know what you're answering and why you're answering it the way you are, so that there are no conflicts or issues later on when things get looked at a deeper level. Reviewing the results for reasonableness, you can compare prior year to current year. That's another good way to look at it. If, let's say, you fail in the current year, you failed testing in the current year, but you passed the previous year, why did that happen? Was there less participation this year? Were there more HCEs categorized in the current year versus last year? What happened that caused us to fail? And what can we do to fix that, right, going forward, so it doesn't perpetuate itself into subsequent years, right? So examine census data to help ensure 5% owners and their family members are properly classified as HCEs. These are just different ways to avoid it. Establish controls to ensure census data is complete and accurate. Ask your plan service provider or plan advisor about a potential change in plan design. Maybe it's a simple, change to go to automatic enrollment, or to change to a safe harbor plan status. Like if you do that and it causes you not to have these failures every year, then it might be the way to go. Excess contribution refunds need to happen within 2.5 months in order to avoid an excise 10% tax. So again, it's important to get this done timely and before, have the test run within that time frame, so that if there is refunds to be made, you can make that happen without having to pay that 10% excise tax. Corrections not made within 12 months, which it can happen, right? I mean, if let's say this is caught during the audit happens 7-8 months later, you wait to fix this, months after that, then it could require a QNEC, right? So that's something else you want to avoid, just because it just adds more cost to the whole thing.
Thanks, Alex.
Yeah.
Forfeitures. So forfeitures are interesting, mostly because at least in my mind, many of us, when we think of forfeitures, are, at least in my experience with working with plan sponsors on audits, has been, well, we're a safe harbor plan. Everything's 100% vested. How could we have forfeitures? It's a good question. They do exist. They actually typically do exist, usually in material amounts, but as we'll touch on here, unfortunately, there are compliance-related elements that you want to dot the i's and cross the t's when it comes to forfeitures. Anytime your plan has an error in funding, meaning usually, sorry, what I mean by that is that you overfund the given payroll. Maybe you have a given individual, you calculate the deferrals, and you realize, oh shoot, we included ineligible compensation. And so you say, okay, sorry, here's your deferral back. And then you say, well, what about the company component? Well, it's going to go to forfeitures typically. And so it's not impossible to have a plan where everything's 100% vested, but you actually still have a forfeiture balance. And if it's been going on long enough, it could, it could easily tick up to not likely to be material amount, but certainly enough that you say, oh, that's enough to actually pay for something. And so that's really what we wanted to touch on here. In addition to the more standard forfeiture error usages that we see, which is that people have a forfeiture account and it's kind of out of sight, out of mind. The IRS actually requires you in what's called an allocated plan, which any 401k or 403b plan is, because everything's allocated to participant accounts. You're not supposed to have any unallocated monies within that plan, which forfeitures is. And so generally speaking, you want to make sure you're using your forfeitures by the end of the plan year after the plan year in which they originated. So for example, if you had any forfeitures during your 2023 plan year, we'd really strongly suggest you get those forfeitures used that were generated by the end of your 2024 plan year. What can you use forfeitures for? Your plan documents will specify the specifics, but generally speaking, forfeitures may be used to reduce future company contributions to the plan or employer contributions to the plan, pay eligible plan expenses, amongst which are audit fees. So maybe if you're looking for a way to kind of haircut your audit fees that you're paying, forfeiture account's a great way to be able to do that. You can also allocate the forfeitures amongst participants who are feeling more generous. That can be involve a little bit of legwork, but still it's typically a permitted use of forfeitures. And then also to restore previously forfeited participant accounts. I had one client years ago that had a substantial forfeiture balances within the plan that we were auditing. And it was extremely difficult to get them to understand that once something is categorized as a forfeiture, you can't just keep it in reserve in case some of these terminated people who forfeited balances show up and say, hey, I'm coming back to work and now you need to reinstitute that portion of their account. That's just not a permissible way to treat this. Once something is categorized as forfeitures, and there are some very specific rules about when something is to be properly categorized as a forfeiture, you really need to treat it according to the rules that are set forth by your plan for the treatment of forfeitures. You don't want to just hang on to it as an in case sort of kind of way to break the fall. But I think that's really what we wanted to make sure we shared when it comes to forfeitures.
Very good. And the other thing too is that the plan document might specify the order of how you're supposed to use those forfeitures. So make sure that you're reading the specifics on the plan document, because if it says, use it to cover plan expenses before you allocate to employees, then that's the order it should be done in. So incorrect vesting calculations, I want to make sure I leave some time for the last point, because that's going to be a big one as far as delinquent filing. So with vesting calculations, knowing your plan document and how it reads, right? There's different language involved with this, right? There's graded vesting and there's cliff vesting. The graded vesting, it could be an example here, 25% vested after every year of service until fully vested after 4, right? Or you could have cliff vesting, where after year 1 or 2, you have no credit for vesting until you actually hit 3 years of service, right? In this example here. So very important to make sure that you're reading your plan document and that the plan is operating the way it should be. There's also 2 different methods of crediting vesting, right? Elapsed versus actual hours. So, if it's actual hours, how is the record keeper gaining that information as to, whether they hit the actual hours to be able to pay out the distribution the right way and not have, that money go out, maybe if they didn't hit the 1,000-hour requirement for a certain number of years, right? So we've seen that situation where money has gone out, distributed out to the employee, where they're fully vested and maybe they didn't even hit the 1,000 hours for the time that they were with the company. So, making sure that, if it doesn't make sense to have actual hours and you want to have a lapse, then amending the plan accordingly so that it works for you. Certain types of money sources are always 100% vested. That's important to know because the money could go into the wrong money source. I had one plan that I audited where it was supposed to be safe harbor classification on the employer money, but it was actually a traditional employer match is where it was sourced to. So, if an employee leaves and that money is categorized not as safe harbor, which is typically 100% vested, then that's money they're out. They're that they end up forfeiting without that being that shouldn't happen, right? Shouldn't be the case. So then, it's getting a hold of that employee, making that corrective distribution back out to them. And it's just a hassle to go through. So something you definitely want to avoid. How do we avoid it? Read your plan document, right? Be sure that you understand the plan's vesting requirements, including your method of crediting vesting or service. Implement controls to help ensure all census data communicated to your plan service providers is complete and accurate. Is there a rehire date in the mix, right? Are you using original date of hire? Are you using rehire date? What should it be when you're submitting that information over as far as crediting that vesting period? And how do we fix the mistake? Employee plans, you have EPCRs, which is an IRS way of making that correction. They have the program to be able to correct it that way, typically through self-correction, maybe either self-correction or voluntary correction through that program as well. So there's different ways to fix. Must be fixed within 2 years of the plan year in which the failure occurred, corrective contribution or a refund request, depending on how it happened. But yeah, it happens. And many people think that with automation, these errors shouldn't happen, but there's a reason why we do what we do.
All right. So last but certainly not least, delinquent form 5500 filings. We got 4 minutes officially left in this, so I'm gonna burn through this. But if anyone has any specific questions they want to ask afterwards, Alex and I are happy to hang around after this. So just be aware of that. So I apologize for how quick this is gonna go. Long and short, 5500s are always due 7 months after your plan year end date. Keep in mind that if your plan, if you're dealing with a terminated plan, a plan that merged into another plan, your terminated plan, the month in which your last dollar left, if it's earlier than your normal plan year, just became your new plan year. Congratulations. If you merged into another plan, whenever that merger happened, that's your new plan year. Congratulations. Set your clocks accordingly. All 5500s may be extended. That extension is good for up to another 2.5 months afterwards. I'm not going to talk about what qualifies you as a large versus a small plan. It's here on the slide that we'll be sharing. And we're happy to talk about it if you have any questions to get into that further. Because what I primarily want to talk about is that, okay, so you get to your filing deadline, you're not done. What do? You have 2 options. You can either do nothing, hear me out, you do nothing and you are automatically enrolled into the delinquent filing voluntary compliance program, love the acronyms, or you can file an incomplete form 5500. Now, when it comes to these 2 options, there we go. When it comes to these 2 options, there are some things you should be aware of. First of all, if you go into the delinquent filer program, you are going to have to pay a fine. The fine, good news, fine is capped at $2,000. And you're going to have to pay an additional filing fee in order to get your 5500 filed whenever you do finish the audit. And so it's good because it gives you some certainty. It's basically a fee you pay to the government to take as much time as you need to complete your audit. Cool. If you go the incomplete filer route, typically there's an order of operations that happen after that. So you file your letter or you file your 5500 with some sort of letter or other communication that says, sorry, we're still working on it. Typically what will happen after that is you'll either get an email notification from the DOL that says, hey, we noticed you haven't finished yet, get it done. That's it. No threats, nothing else, just a kind of a love tap on the shoulder saying, hey, we're watching. The other option is that you'll actually get a formal letter that says, hey, we noticed you're not done yet, get done in 45 days or we're going to fine you. And if you're not done within those 45 days, then they'll follow up with a 30-day letter that says, congratulations, you failed. We are now going to fine you within the next 30 days unless you, again, are able to take action. And here we actually have some examples of what these look like. So here is an example of what an email looks like. When we talk about an email, this is what it reads as. This is one we got recently. This is got this very recently. So this is what it looks like. As you can see, there's no threats, there's nothing else. It literally comes as an email to you. When I talk about letters, we're talking good old-fashioned USPS mail. And here's an example of what the 45-day letter looks like. Again, it even says 45 days on it. You'll see that there is typically a dollar amount mentioned. There it is. There's the penalty per day, $2,670. And yeah, after this comes the 30-day letter, which looks like this and says, congratulations, you failed, and you get to now pay the government $33,450 in this example. So you can see clearly there's a very different form to these letters. The most important thing that we would emphasize for any and all of these communication is be honest and open with the DOL. Do not ignore it. Do not just pretend it's going to go away. This is all these guys do, and you know the government. It might be slow, but it's like a glacier. If you stand in the way, you will get run over. So you want to make sure that you are being active in your communications with them. And as I mentioned previously, this was the teaser, so here's the payoff. The DOL is not in the business of shutting plans down. They're in the business of compliance. So you really want to make sure you're just you're being open and honest with them about where you are, where you stand, what's going on with your auditor and everything else. You just want to make sure you're keeping that communication open and honest and fluid with them if you find yourself in this situation. So please just be mindful of that. Do not ignore these. I've had clients where no one knew what to do with these letters, and so they did the worst thing possible, which was they ignored them. And so you don't want to be in that position. So please keep that in mind. There we go. That was the quickest way I thought I'd be able to get through that. So here's my contact information. Here's Alex's confirmation. Here's the firm's contact information. I see we have one Q&A, and all it says is, okay, great presentation, very helpful. Awesome. You're welcome. I'm glad we could help.
Yep,
That's what we're here
and then
for.
there was a couple more questions on the slides. Again, the slides will be sent to everybody who registered for the event, so do not worry. We'll send you the YouTube link as well. You can share them with whoever may need them. Someone had asked about one-pagers, if we had one-pagers on some of this information. I think the slides are comprehensive enough, as far as being able to cover it all, and you can definitely feel free to share that information. But if there's additional, specific questions, we're happy to answer them. You have our codes here for our LinkedIn, email, call us, reach out anytime. We're happy to help. And again, I know we're a little over,